Ladies and gentlemen, what if I told you that the real financial system isn't as stable as it looks? And when confidence cracks, it doesn't break slowly, it breaks all at once. In history, when paper promises weaken, real money reemerges, not stocks, not crypto, but physical metal. And today I want to make a very simple but uncomfortable case. Owning just 1 kilogram of silver may not be speculation, it may be insurance for what comes next. Into silver is often described as an industrial metal, a commodity, or a trading instrument, but that framing misses the deeper truth. Across long stretches of human history, silver has functioned as money in the most fundamental sense, a universal recognized store of value that does not depend on the promise of any issuer. When you step back from the daily noise of markets, what becomes clear is that silver is not simply part of the financial system, it is one of the original foundations of it. And that matters because monetary systems do not evolve in a straight line. They cycle through trust, expansion, distortion, and eventually reset. For centuries, civilizations anchored their economic life to precious metals because they solved a basic problem. How do you store purchasing power across time and distance without relying on someone else's liability? Paper claims, digital balances, and credit systems all depend on confidence. Silver does not. It carries intrinsic value because it is scarce, costly to extract, and universally recognized. That is why it was used in coins from ancient empires to early modern economies. The moment a society begins to expand its monetary base beyond what is physically constrained, silver quietly begins to regain relevance as a parallel standard of trust. Modern financial systems are built on layers of abstraction. Currency is no longer tied to physical redemption, but to institutional credibility. Central banks manage liquidity through policy rather than constraint. This creates periods of stability, but it also introduces fragility that is not immediately visible. When confidence is high, paper claims are accepted without question. When confidence weakens, the hierarchy changes quickly. In those moments, assets that exist outside the liability structure of the financial system tend to reassert themselves. Silver sits directly in that category. The important dynamic is not just monetary expansion, but the gap between promises and deliverability. Financial markets can create almost unlimited claims on assets through derivatives, leverage, and fractional structures. Silver, however, exists in physical form with real-world limits on production and refining capacity. This creates a dual reality. One price exists in paper markets, another in physical exchange. For long periods, the two appear aligned, but history shows they can diverge sharply when stress increases. The divergence itself is not the event, it is the warning. What makes silver particularly sensitive is its dual identity. It is both a monetary metal and an industrial input. That means demand comes from two directions at once: investment demand driven by fear and certainty, and industrial demand driven by technological growth. When monetary confidence declines while industrial consumption remains steady or increases, supply stress can develop faster than most participants expect. Markets often underestimate this until physical availability becomes constrained. There is also a psychological dimension that cannot be ignored. Most participants in modern financial systems are conditioned to believe that value is primarily digital, and financial engineering can replace physical scarcity. But in periods of instability, behavior changes. Investors do not move toward complexity, they move toward simple simplicity. They seek assets that do not require counterparty trust. Silver, unlike many financial instruments, does not rely on redemption promises, balance sheets, or policy credibility. It simply exists. This is why historical cycles matter. When monetary regimes reach their stress points, they rarely fail in a gradual, orderly way. Instead, confidence erodes unevenly, and the shift toward tangible assets accelerates quickly once it begins. Silver has appeared in this role repeatedly, not because it is fashionable, but because it is functional. It bridges the gap between pure monetary trust and physical reality. In that sense, silver is not reacting to modern speculation. It is responding to a much older pattern. The recurring tension between paper-based monetary expansion and the finite nature of real assets. Every era believes its system is different, more advanced, more stable than what came before. Yet, the underlying constraint never changes. Confidence must be continuously maintained, and when it is not, the system reverts toward what cannot be defaulted on or digitally expanded. That is why silver continues to reappear in discussions of monetary resilience, not because it guarantees outcomes, but because it represents continuity across monetary regimes. It is one of the few assets that has functioned as money before modern finance existed and still retains relevance within it. And in periods where uncertainty rises faster than clarity, that historical continuity becomes more than background, it becomes signal. Markets often operate on a comfortable assumption. If a price exists, supply must be sufficient. That assumption works in ordinary conditions, but it becomes fragile when the asset in question has both industrial importance and monetary sensitivity. Silver sits exactly at that intersection. On paper, it appears liquid, widely traded, and easily sourced. In reality, the structure underneath that appearance is far more constrained than most participants recognize, and the gap between perception and physical availability is where the real risk resides. A key misunderstanding comes from how supply is measured. Official figures often focus on annual mine production and reported above-ground inventories. Those numbers create an impression of abundance, but what is rarely discussed is how much of that supply is already committed before it ever reaches the open market. Industrial users enter long-term contracts. Refiners allocate output forward. Investment demand draws from a relatively small pool of freely available metal. What remains as available liquidity is far smaller than headline production suggests. Another layer of complexity comes from the nature of consumption. Silver is not like gold, where a large portion of demand is held in vaults and can re-enter the market if sentiment changes. Silver is heavily used in industrial applications, solar panels, solar medical devices, and specialized manufacturing processes. In many of these uses, the metal is dispersed in microscopic quantities, making recovery economically impractical. Once consumed, it is effectively removed from the investable supply chain. Over time, this creates a silent drain on available stock that does not show up in simple supply-demand charts. At the same time, above-ground inventories that are available for investment purposes are not evenly distributed. A significant portion is held in forms that are not immediately liquid, such as long-term holdings, institutional storage, or product-specific inventories. The freely tradable portion, the metal that can actually move to meet sudden demand, is far smaller than most assume. In stressed conditions, that distinction becomes critical. Markets tend to smooth over this reality through paper instruments. Futures contracts and derivatives create the impression of deep liquidity. They allow participants to gain exposure without requiring physical settlement. Under normal conditions, this structure functions efficiently, but it also introduces a divergence between paper claims and physical metal. The more the system relies on paper substitutes, the more disconnected pricing can become from actual deliverable supply. That disconnect is not always visible until physical demand intensifies. There is also a timing mismatch that contributes to the illusion of abundance. Mining supply cannot respond quickly to price signals. Discovering, permitting, and developing new production capacity takes years, sometimes decades. Meanwhile, demand can shift in weeks or months, driven by macroeconomic changes, industrial expansion, or investment flows. This asymmetry means that supply is structurally slow while demand is structurally fast. When demand accelerates, the system cannot instantly adjust, even if prices signal urgency. Refining capacity adds another constraint that is often overlooked. Even when raw material exists in the ground or a scrap, it must pass through processing infrastructure before it becomes usable in industrial or investment grade form. That infrastructure is not infinite, and it operates within logistical and energy constraints. Bottlenecks in refining can create localized shortages even when global supply appears adequate on paper. Another factor is a concentration of market liquidity. A relatively small number of entities control significant portions of tradable inventory and futures positioning. In such a structure, shifts in positioning can have disproportionate effects on price and availability. If those holders choose to reduce exposure or demand physical delivery, the system can experience stress much faster than expected. What ties all of this together is not a shortage in the absolute sense, but a shortage in elasticity. The market assumes it can always convert paper claims into physical metal at stable prices, but elasticity depends on surplus capacity that can absorb shocks. In silver's case, that surplus is thinner than it appears. When demand rises sharply or confidence in paper settlement weakens, the buffer disappears quickly. This is why price stability in silver can be deceptive. Long periods of calm do not necessarily reflect abundance. They often reflect suppressed volatility under conditions where physical demand remains within controllable bounds. The real test of supply is not during equilibrium, but during stress. And in those moments, markets tend to discover that the margin for error is far smaller than the charts suggested. Ultimately, the key point is not that silver is disappearing, but that accessible silver, the kind that can move freely in response to demand, is more limited and more fragmented than most participants assume. And when an asset combines industrial necessity with monetary sensitivity, that limitation becomes more than a technical detail, becomes the central driver of how the market reprices under pressure. Markets are often described as rational mechanisms for allocating capital, but in practice, they behave more like liquidity systems. Prices are not set solely by long-term value. They are set by the availability of cash, credit, and leverage at any given moment. When liquidity is abundant, even marginal assets can appear stable or underpriced. When liquidity contracts, the same assets can move violently in a short span of time. Silver is one of the clearest examples of this dynamic because of its structure, size, and dual role in both industrial and monetary demand. The key characteristic of silver is not just volatility, but sensitivity. It does not require fundamental collapse in value to move sharply. It requires only a shift in liquidity conditions. In a highly leveraged financial system, small changes in funding costs, margin requirements, or risk appetite can cascade through markets in nonlinear ways. Assets that are heavily traded but relatively small in global capital terms tend to experience the most exaggerated responses. Silver fits that profile precisely. One reason for this sensitivity is the size of the market relative to global financial flows. Compared to major currencies, sovereign bonds, or large equity indices, silver represents a small pool of capital. That means incremental inflows or outflows can have outsized price effects. When liquidity is flowing into risk assets, silver can rise rapidly as speculative positioning increases. When liquidity reverses, that same leverage wins in the opposite direction, often more aggressively than the initial move. Another structural factor is the prevalence of leverage exposure through derivatives. A significant portion of silver trading does not involve physical metal, but paper contracts that allow participants to control large positions with relatively small margin requirements. This creates a condition where price stability depends not on physical scarcity, but on the continuous refinancing of positions. As long as liquidity is abundant, leverage amplifies upward and downward moves in a controlled manner. When liquidity tightens, that amplification becomes destabilizing. Liquidity shocks typically originate outside the silver market itself. They begin in funding markets, credit channels, or macroeconomic policy shifts. A rise in interest rates, a tightening of dollar funding, or a sudden increase in margin requirements can force broad deleveraging across multiple asset classes simultaneously. In such environments, silver is not reacting to its own fundamentals. It is reacting to the forced liquidation of positions held by investors who need cash quickly. That is an important distinction because it explains why silver can fall even when long-term supply-demand conditions remain supportive. There's also a behavioral dimension. In periods of stress, market participants tend to reduce complexity and risk exposure. Assets that are perceived as volatile or non-essential are often liquidated first, not because they are fundamentally weak, but because they are liquid and accessible. Guys, silver trades in deep and active markets, making it an efficient source of liquidity during portfolio stress. That very liquidity becomes a vulnerability when forced selling begins. The feedback loop in these conditions is important. As prices decline due to liquidity-driven selling, margin pressures increase. That leads to further liquidation, which drives prices lower again. This is not a reflection of intrinsic value, but a forced behavior under financial constraint. Silver, due to its size and leverage structure, tends to sit at the center of this feedback mechanism. However, the same mechanism works in reverse. When liquidity returns, silver often rebounds sharply. The compressed nature of prior selling creates a situation where small inflows of capital can produce outsized price recoveries. This is why silver is frequently described as having asymmetric behavior during macro cycles. It is not smooth or linear. It is reactive to the direction and intensity of liquidity flows. It is also important to understand that liquidity conditions today are more interconnected than in previous eras. Global markets are linked through derivatives, currency funding structures, and algorithmic trading systems. A liquidity event in one region can transmit rapidly across multiple asset classes. In such an environment, silver is exposed not only to domestic financial conditions, but to global liquidity cycles. The critical insight is that silver does not require change in long-term fundamentals to experience significant price movement. It requires a change in financial conditions. That distinction is often overlooked by those who focus exclusively on supply and demand metrics. In reality, short to medium-term price behavior is dominated by liquidity, not physical scarcity. This is why silver's reaction profile is so distinct during periods of financial stress. It does not drift, it moves. It does not adjust gradually, it reprices rapidly. And it does so because it sits at the intersection of leverage, speculation, industrial usage, and monetary perception. When liquidity is stable, these forces coexist. When liquidity contracts, they collide. In modern financial systems, price discovery is often assumed to be a direct reflection of real-world supply and demand. That assumption depends on a critical condition that the claims traded in markets are sufficiently connected to the underlying physical asset. When that connection weakens, prices can continue to function, but their meaning becomes less reliable. Silver provides one of the clearest examples of this divergence, where paper representations of the metal and physical availability increasingly operate on different timelines and sometimes different realities. At the center of this issue is the structure of modern commodity markets. A large portion of silver exposure is not held in physical form, but through futures contracts, exchange-traded instruments, and unallocated accounts. These instruments are designed for efficiency, allowing participants to gain exposure without handling physical metal. Under stable conditions, this system works because only a small fraction of contracts require actual delivery. Most are settled financially or rolled forward. The assumption is that physical settlement is always possible, even if rarely demanded. The problem emerges when that assumption is tested. The number of outstanding paper claims on silver often exceeds the amount of freely deliverable physical metal available in exchange inventories. This does not create an immediate issue in normal conditions because participants are not simultaneously demanding delivery. However, the structure depends heavily on confidence. As long as market participants believe that physical delivery is guaranteed if needed, the system remains stable. Once that belief is questioned, the relationship between paper price and physical availability begins to strain. Physical silver exists in multiple forms: investment bars, industrial stockpiles, and recyclable scrap. However, not all of it is accessible to the market at any given time. A significant portion is held in long-term storage or embedded in industrial applications where recovery is not economically viable in the short term. What remains available for immediate delivery is a much smaller pool than headline supply figures suggest. This creates a structural imbalance between theoretical claims and actual deliverable metal. The divergence becomes more pronounced in periods of heightened demand. When investors shift toward physical ownership, they are not simply changing exposure. They are moving from paper claims into a finite physical supply chain. Unlike paper instruments, physical silver must be sourced, transported, refined, and allocated. These processes introduce friction that does not exist in electronic trading. As demand for physical metal increases, premiums begin to appear, signaling that the paper price is no longer fully aligned with the cost of immediate delivery. Another factor contributing to the widening gap is leverage embedded in derivatives markets. Futures contracts allow large positions to be controlled with relatively small capital requirements. This amplifies liquidity and price efficiency under normal conditions. However, it also means that the notional exposure to silver in the financial system can be many times larger than the amount of physical metal backing those contracts. As long as positions are rolled and settled financially, the discrepancy remains hidden. But if a significant number of participants demand delivery simultaneously, the system must source physical metal that may not be readily available at prevailing prices. Refining and logistics constraints further complicate the situation. Even when physical silver exists in aggregate, it is not always in the right form, location, or quality required for immediate delivery. Converting industrial grade or semi-processed material into investment grade bars takes time and capacity. Transportation and storage add additional constraints. These factors mean that physical tightness can emerge locally or temporarily, even when global inventories appear sufficient on paper. The gap between paper pricing and physical reality is not static. It is dynamic and can widen rapidly under stress. In calm markets, arbitrage mechanisms keep the two relatively aligned. Traders move between physical and paper markets, smoothing discrepancies. But those mechanisms depend on functioning liquidity, predictable financing conditions, and confidence in settlement. When any of these elements weaken, the linkage becomes less efficient. What makes silver particularly sensitive is the speed at which sentiment can shift from passive acceptance of paper pricing to active demand for physical possession. This transition is often triggered not by fundamental scarcity, but by perception, specifically the perception that others may attempt to secure physical metal ahead of them. Once that behavior begins, it can accelerate quickly, creating temporary shortages and price dislocations between paper contracts and physical premiums. Over time, these episodes reinforce a structural truth. Paper markets are pricing mechanisms, not storage mechanisms. They reflect expectations, positioning, and liquidity conditions, but they are ultimately anchored to a physical asset that exists in limited and sometimes inaccessible supply. When the system is functioning smoothly, the distinction is easy to ignore. When stress appears, it becomes impossible to overlook. The widening gap is therefore not simply a technical issue within commodity trading. It reflects a deeper tension between abstraction and physical constraint.